Welcome to today's quick lesson about banking. Banking can be very confusing or mysterious, but when you know the basics, banking can be used to help you reach your financial goals, whatever they may be. First, let's understand how the term banking will be used in this presentation. Banking is a verb for you're interacting with a bank or credit union, and when we refer to a bank, it includes a bank, credit union, or savings and loan institution. Banks and credit unions are important financial institutions that have many similarities. Generally, they keep our money safe and provide savings and wealth building products to its customers. Things like car loans, mortgages, savings accounts, and checking accounts, to name a few. How they do it is different. Listed here are the major differences between each. Banks are for profit. The profit goes to the shareholders who own a stake in the company and not the customers. Credit unions, on the other hand, are non-profit, and any profit they make goes to its customers who they refer to as members. Many offer more competitive interest rates compared to banks and may have lower fees. Banks, though, are generally more widely available, having more branches and have more savings and loan products for its customers. Which one you decide to use depends on what you find most important about managing your money. Here are some examples. If you need the capability to access a branch most anywhere you go, consider a bank. If you need your financial institution to cater to you, their customer, more than a shareholder, consider a credit union. Many people ask, when you put your money into the bank, do they safely store it in the vault for you until you need it? No, they actually utilize the funds to lend out to other people for loans to buy cars, houses, or other items. The bank will pay a small interest percentage to you for keeping your money in the bank and allowing them to, in turn, lend it out to someone else for a high rate. This is one of the ways they make money to operate their business. Other people ask, but if they've lent out my money, how do I know I'll get it back? You can withdraw and use your money at any time. Both banks and credit unions are regulated to ensure that your money is safe. You're insured up to $250,000 at each bank or credit union. If you have more money than this in the account, you may consider diversifying where you invest your money. Make sure that your institution is insured by looking for seals from the FDIC for banks or the NCUSIF for credit unions. There are many ways to store your money, like under your bed or somewhere else in your house. But there are many reasons why that's not a great idea. Not only is there limited space in case you hit it big, but it's also at risk of being stolen or destroyed by a fire. Using a bank or credit union instead is your safest bet. Why? It keeps your money safe. Remember, your deposits are federally insured up to $250,000. It allows you to build a relationship with a financial institution who might offer you better interest rates down the line if you want to borrow money from them later for a mortgage or an auto loan. It can save you money on check cashing or money orders. Catching your paycheck can cost you money if you don't have a bank account, but it's 100% free if you do. The key is that based on how you use your money, different banks or credit unions might be better for you. Here are 3 different banks comparing some of their features. You can find this kind of information on the institution's website or on a financial blog like NerdWallet. Which would be best for someone that keeps a low balance and is a total techie? Account C, since there is no minimum balance and they can access their account online. How about for someone who has their paycheck direct deposited and likes to speak with a real person when they bank? Account A. Direct deposit is available and they like visiting a physical branch. Finally, what about someone who just wants the best interest rate on their money? Account C, since it has the highest interest yield at 0.25% compared to 0.01% or 0.05% with the others. If you want to practice a little more with this style of research, check out the activity called Monica and Sarah on page 11 of the downloadable resource guide. To start your own research and help you find your own financial institution, page 10 is a worksheet to help you track your findings. 2 of the most common products that banks and credit unions offer are checking and savings accounts. I always recommend having both, but what's the difference? For checking accounts, think of the money in it as money in your wallet. That money is designated for spending on your daily needs and wants, such as groceries, paying bills, and buying gifts. You can withdraw money from your checking account by using an ATM, writing a check to an individual or a company, or by using your debit card at a store. It's not very common, but there are some checking accounts that accrue interest for you, meaning you'll earn a bit of money just by storing your money in the account. Savings accounts are a little less flexible, but very important. To prepare for the future and be able to weather financial crises like the ones many of us are feeling right now during the coronavirus, it's really important to have savings. It's great for building your emergency fund for things like car repairs or a job loss, and for short-term goals like a vacation fund or buying a new laptop. All savings accounts accrue interest for you, but not as much interest like investing in a retirement account. Each month, you're allowed to withdraw from it only a few times to encourage you to keep as much of your savings in the account as possible. I mentioned the word interest quite a few times, and many of us might know the term as the money we pay back when we borrow from a credit card or through a loan. But did you know that interest can also be paid to you? All savings accounts have what we call the annual percentage yield, or the money a customer receives from a bank. While APY stands for annual percentage yield, it's not usually compounded annually. Instead, it could be daily, monthly, quarterly, or annually. What's a good APY to go for? Right now, the most competitive rates I'm seeing is 1.6%, but I've seen it as high as 2%. It doesn't sound like a lot, but when compounded annually, you can earn a few $100 each year just by not spending your money. Here's a math problem that will help you understand how interest is calculated. If your savings account's APY is 1% and compounded monthly, that means each month your yield is 0.08%. I just divided my APY by 12 months. When you're picking a bank, ask what their savings account APYs are. The higher the APY, the better it is for you. There are two ways interest can build upon your savings. First is simple interest, which is paid or earned only on the principal amount. The second way is compound interest, which is earned on principal and accrued interest. Based on the information on page 4 of your downloadable resource guide, this graph compares $100 at 5% calculated with simple versus compound interest. After 5 years, it grows about the same for both simple and compound, but look ahead to 20 years and compound interest performs way better. That means it's very important to start saving early so your money can earn more money on its own. It's important to understand that when you're looking at the balance listed on your account, it may not mean that you have that much available to spend. Pay attention to what that is, which is called your available balance. It equals your current balance plus your outstanding deposits minus outstanding purchases. Outstanding deposits won't reflect in your available balance right away. Your bank might put a hold on the check to ensure it can be cashed, and you may not be able to use those funds for a few days. Some outstanding purchases will still require a check, like your rent. It can take time for that check to clear, so take into account the outstanding purchases that may not be showing in your current bank balance. Keeping track of your available balance will ensure that you do not overdraw from your account. You can track spending on your own using some really helpful tools. First up, most banks and credit unions allow you to access your account anytime via online banking. You're able to categorize your spending, pay bills online, and even access accounts from other institutions. Microsoft Excel or Numbers can be used to easily manage your accounts using spreadsheets. You can easily Google budgeting templates that you can adapt for your own use, and there are different styles to try. Quicken and QuickBooks are examples of accounting software you can purchase to keep track of your money. Many free online money management programs have been created, and many have apps for your phone. Mint.com, for example, is free and allows you to pull in information from all your institutions and easily see your net worth and manage a budget. Finally, the classic check register is still a powerful tool to manage your account balance, even if you find you do not write checks. One big misconception about banks is that they charge a lot of fees. But if you do your research and do a few things, you can avoid fees altogether. Here are some ways to do that. Don't pay ATM fees by using your own bank or their partners' ATMs. If you're not able to avoid it, then take out larger sums less often. Keep track of your spending. If you do this, you'll ensure that you do not overdraft your account, and you'll be aware of your purchasing habits. Set up direct deposit. Direct deposit is when your employer electronically deposits your paycheck directly into your bank account. It is very convenient, and many times the bank will waive the monthly fee if you utilize it. Finally, ask for the occasional fee reversal. If you overdraft your account and have never done it before, many times the bank will reverse the fee for you as a courtesy. It doesn't hurt to ask, and the worst they can say is no. So make sure to call your bank and ask. In another module, we'll talk a lot more about credit cards, but for now, I'll outline for you the difference between debit cards and credit cards. They look very, very similar, so it's important that you know how each operate differently. When you swipe a debit card, you're taking money directly from your checking account. When you swipe a credit card, you're borrowing money and must pay it back. When it comes to interest, there's no interest payment when you use your debit card, but there is an interest payment if you swipe your credit card and can't pay it back right away. Security-wise, your debit requires a PIN to use, and any fraudulent charges you report may take a little longer to be resolved. Credit cards, on the other hand, are easier to dispute your fraudulent issues. Finally, since your debit card is connected to your checking account and takes money directly, it doesn't help you build credit history, but credit cards do. Make sure you understand all the details before using a credit card, though. The last tip I'll leave you with when it comes to banking is to protect your identity. There are people out there who make a living out of stealing other people's identities and using their money, which is called identity theft. When you're a victim of identity theft, you may lose money or your credit score may be negatively affected. By protecting your identity as much as you can safeguard against this. Some ways to do that: shred important financial documents. Be careful who you give your account information to, like your passwords and PINs. Report fraudulent activity right away. Don't carry your social security card on your person, but instead store it somewhere safe, and monitor your accounts regularly. So that's it for banking. Here are the takeaways for a summary. Choose a checking and savings account with a bank that charges no monthly fees and works for you. Get a debit card and never overdraw your checking account. Protect your identity to guard against identity thieves and financial trouble. And finally, make sure you understand the interest your checking or savings accounts offer so you can take advantage of the best rate. Don't be afraid to ask someone at the bank all your questions. Your bank should work for you. If you succeed in executing these critical elements of banking, you'll be well on your way to establishing a financial foundation that will provide you a significant amount of comfort and peace in your life. Thank you for your time.